Preparing for a financial analyst at Lumen interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Lumen? I am interested in Lumen because it combines a complex telecommunications network with an ongoing transformation toward higher-value enterprise and digital services. That environment would let me apply financial modeling, variance analysis, and operational research to decisions with visible business impact. I also value roles where finance partners directly with operating teams. Lumen's scale, recurring revenue base, and focus on improving efficiency make it an attractive place to develop as an analyst while contributing practical, decision-useful insights. While answering, connect your analytical skills to Lumen's telecommunications transformation, emphasize interest in forecasting and business partnering, and explain how the company's network, enterprise, and digital solutions create meaningful analytical challenges. Question 2. Walk me through your approach to building a financial forecast. I begin by understanding the business model and identifying the operating drivers behind revenue, costs, cash flow, and capital spending. I review historical trends, normalize unusual items, and build assumptions from operational data rather than applying arbitrary growth rates. Then I create base, upside, and downside cases, reconcile the forecast to financial statements, and test sensitivities. Finally, I discuss major risks with stakeholders and document assumptions so the model remains transparent and updatable. Make sure to cover historical analysis, key operating drivers, management assumptions, scenario design, revenue and expense modeling, validation checks, and clear communication of risks rather than simply describing spreadsheet construction. Question 3. How would you analyze a revenue variance at Lumen? I would first reconcile reported revenue to the budget and prior year period, confirming that the comparison uses consistent accounting and timing. Next, I would decompose the variance into customer volume, pricing, product mix, churn, usage, contract timing, and foreign exchange where relevant. For Lumen, I would examine trends across enterprise, broadband, and other offerings. I would then quantify recurring versus temporary drivers and recommend actions, such as retention efforts, pricing changes, or revised forecasts. In your answer, talk about separating volume, price, mix, churn, foreign exchange, timing, and accounting effects, comparing actuals with budget and prior year, and converting findings into management actions. Question 4. Which financial statements are most important to a financial analyst, and how do they connect? All three statements matter because they answer different questions and must reconcile. The income statement shows operating performance, the balance sheet shows resources and obligations, and the cash flow statement explains how earnings translate into cash. Net income flows into retained earnings and begins operating cash flow, while working capital, capital expenditures, and financing activities bridge accounting profit to cash. I would never assess performance from earnings alone. Liquidity and balance sheet capacity are equally important. Be sure to mention the income statement, balance sheet, and cash flow statement, explain the links among net income, working capital, debt, and cash, and distinguish profitability from liquidity. Question 5. What financial metrics would you monitor for a telecommunications company like Lumen? I would monitor revenue growth by segment, customer additions and losses, churn, average revenue per user, and the mix between legacy and higher growth services. Financial measures would include adjusted EBITDA, margin, free cash flow, capital expenditures, capital intensity, net leverage, and interest coverage. I would connect the metrics. Rising subscribers without improving economics may not create value, while lower churn and disciplined investment can strengthen recurring cash flow and debt capacity. Focus on revenue growth, customer churn, average revenue per user, adjusted EBITDA, margins, free cash flow, capital intensity, leverage, retention, and segment-level performance, while explaining why operational metrics support financial interpretation. Question 6. Explain the difference between EBITDA, EBIT, and free cash flow. EBITDA measures earnings before interest, taxes, depreciation, and amortization, so it highlights operating performance before non-cash asset charges and financing decisions. EBIT includes depreciation and amortization, making it closer to operating profit after asset consumption. Free cash flow goes further by reflecting taxes, working capital movements, and capital expenditures. In a network-intensive business, that distinction is critical because substantial investment may reduce cash available despite attractive EBITDA margins. While answering, define each metric, identify depreciation, amortization, taxes, interest, working capital, and capital expenditures, and explain why analysts should not treat EBITDA as equivalent to cash generation. Question 7. How would you evaluate whether a capital expenditure project is worthwhile? I would evaluate the project using incremental after-tax cash flows, separating maintenance investment from growth investment. I would forecast revenue, operating costs, working capital, taxes, and residual value, then calculate NPV using an appropriate risk-adjusted discount rate. I would also review IRR, payback, and sensitivity to adoption, pricing, and construction costs. A positive NPV is important, but I would incorporate strategic benefits and execution risks before recommending approval. Make sure to cover incremental cash flows, useful life, discount rate, NPV, IRR, payback, strategic benefits, downside scenarios, and the difference between maintenance and growth capital expenditures. Question 8. Describe a time you found an error in a financial model or analysis. In one analysis, my forecast showed an unexpected margin expansion that did not match operational trends. I traced the variance through supporting schedules and found that a monthly expense had been included twice in the historical period but omitted from the forecast. I corrected the source data, rebuilt the affected formulas, and reconciled the outputs to the general ledger. I then added a reasonableness check comparing expense growth with headcount and activity, reducing the chance of recurrence. In your answer, use a clear situation action result structure, explain the control or reconciliation that exposed the issue, show how you corrected it, and mention process improvements that prevented recurrence. Question 9. How do you prioritize competing requests from senior stakeholders? I prioritize requests by decision deadline, business impact, dependency, and effort required. I clarify what decision each analysis supports and distinguish genuinely urgent work from requests that are merely visible. If priorities conflict, I communicate the trade-offs early and propose a delivery sequence, perhaps providing a concise preliminary view first and a fuller analysis later. I maintain a task tracker, protect time for quality checks, and confirm expectations so stakeholders are not surprised. Be sure to mention urgency, business impact, decision deadlines, data availability, stakeholder alignment, transparent communication, and a practical system for sequencing work without sacrificing analytical quality. Question 10. How would you investigate a decline in Lumen's operating margin? I would build a margin bridge from the prior period or budget, separating revenue effects from cost effects. On revenue, I would examine pricing, churn, customer mix, volume, and lower margin offerings. On costs, I would review labor, network operations, vendor pricing, energy, restructuring, and unusual items. I would also verify whether depreciation or accounting classifications changed. After isolating recurring drivers, I would quantify management levers and update the forecast under realistic recovery assumptions. Focus on revenue mix, pricing, churn, labor, network expenses, restructuring, inflation, depreciation, and one-time items. Explain variance bridges and distinguish controllable issues from accounting or timing effects. Question 11. What is working capital, and how would you analyze its impact on cash flow? Working capital represents operating assets and liabilities that absorb or provide cash. I would analyze receivables, payables, accrued expenses, deferred revenue, and any relevant inventory, using days metrics and historical seasonality. A rise in receivables may indicate growth, weaker collections, or billing issues, while higher deferred revenue can provide cash before revenue recognition. I would quantify the cash impact, identify sustainable actions, and avoid treating one-time payment delays as permanent improvement. In your answer, explain receivables, inventory, payables, deferred revenue, operating cash conversion, days metrics, seasonality, and the difference between improving cash temporarily and improving sustainable economics. Question 12. How would you assess a company's debt position and financial risk? I would assess net debt relative to EBITDA, interest coverage, free cash flow generation, liquidity, and upcoming maturities. I would review fixed versus floating rate debt, covenant requirements, refinancing needs, and available revolver capacity. Those ratios should be tested under downside cases involving lower revenue, margin pressure, or higher interest expense. I would also consider asset quality and cash flow durability, because leverage that appears manageable today may become risky if legacy revenues decline faster than expected. Make sure to cover leverage, interest coverage, maturity profile, floating rate exposure, liquidity, covenant headroom, refinancing risk, free cash flow, and how operating volatility affects debt capacity. Question 13. What Excel functions and techniques do you use most often in financial analysis? I regularly use Excel OOKUP, SUMIFs, index match when appropriate, if logic, date functions, pivot tables, and dynamic charts. For forecasting, I organize assumptions separately from calculations and outputs, use consistent signs, and include checks for balance, missing data, and unexpected changes. I also use scenario switches and sensitivity tables to assess key drivers. The objective is not complexity, it is building a model that another analyst can audit, update, and understand quickly. Mention structured formulas, Excel OOKUP or index match, SUMIFs, logical functions, pivot tables, scenario tools, data validation, charts, error checks, and disciplined model organization rather than listing functions without application. Question 14. How would you explain a complex financial result to a non-finance executive? I would start with the conclusion and its business implication, then explain the 2 or 3 drivers that matter most. For example, rather than presenting a dense variance table, I might say revenue missed plan by $10 million, primarily because customer losses exceeded expectations, while pricing partly offset the impact. I would separate confirmed facts from assumptions, use a simple visual if helpful, and finish with actions, risks, and any decision required. Focus on leading with the conclusion, using plain language, quantifying the main drivers, separating facts from assumptions, tailoring the detail level, and ending with implications or recommended actions. Question 15. What would you do if your forecast differed significantly from management's forecast? I would first confirm that we are using the same period, definitions, accounting treatment, and business scope. Then I would compare assumptions line by line, validate the underlying data, and speak with operating teams about evidence supporting each view. If differences remain, I would present a bridge, quantify the sensitivity, and explain the risks rather than arguing for my number. I would recommend a documented base case and clearly labeled upside and downside scenarios. Be sure to mention comparing definitions and assumptions, validating source data, discussing operational evidence, identifying judgment differences, presenting sensitivities, and challenging respectfully without treating disagreement as personal conflict. Question 16. How do interest rates affect Lumen's financial performance? Higher rates can increase interest expense on floating rate debt and raise refinancing costs when maturities come due. They also increase discount rates, which can reduce project NPVs and valuations, while potentially slowing customer demand or business investment. I would quantify exposure by debt instrument, review hedges and maturity timing, and stress test interest coverage and free cash flow. The practical conclusion depends on duration, refinancing needs, and how effectively operating cash flow offsets financing pressure. In your answer, cover variable rate debt, refinancing costs, discount rates, customer demand, valuation, interest coverage, hedging, and the difference between immediate income statement effects and longer-term investment consequences. Question 17. How would you analyze customer churn and its effect on revenue? I would separate gross churn from net adds and analyze churn by customer type, product, geography, tenure, and profitability. Then I would estimate the revenue impact using average revenue per user, contract timing, and expected replacement rates. I would compare retention costs with customer lifetime value and acquisition costs, because reducing churn is valuable only when the retained economics justify the investment. I would also consider reporting lags, since cancellations may affect future periods more than the current quarter. Focus on gross and net churn, customer cohorts, acquisition costs, retention economics, average revenue per user, product mix, lifetime value, and the lag between customer losses and reported financial results. Question 18. Tell me about a time you worked with incomplete or unreliable data. During a budgeting project, one operating dataset had missing regional records and inconsistent customer definitions. I compared it with billing reports, prior submissions, and general ledger totals to identify the most reliable base. For unresolved gaps, I used conservative assumptions and created a sensitivity range rather than presenting false precision. I documented every adjustment, reviewed the approach with the data owner, and flagged the limitation in the final recommendation. That allowed management to decide with an honest view of uncertainty. Use a structured example showing data validation, source triangulation, explicit assumptions, sensitivity analysis, stakeholder consultation, and transparent communication of limitations and confidence levels. Question 19. What controls would you build into a recurring financial reporting process? I would establish controlled source files, clear ownership, version naming, and restricted access to key assumptions. The process would include reconciliations to the general ledger, automated checks for missing or duplicated data, balance tests, and variance thresholds requiring investigation. A second reviewer should sign off on material outputs, with documented explanations and an audit trail. I would also maintain process instructions and periodically test whether controls still work as systems, people, or reporting requirements change. Mention source to report reconciliations, access controls, version management, automated validation, review sign-offs, variance thresholds, documentation, segregation of duties, and evidence that controls operate consistently each period. Question 20. What questions would you ask the interviewer at the end of a Lumen financial analyst interview? I would ask how success is measured during the first 6 and 12 months, which forecasts or reporting processes need the most improvement, and how the team partners with operations. I would also ask about the systems used, the balance between recurring reporting and ad hoc analysis, and opportunities to develop deeper business expertise. Finally, I would ask what financial or strategic issue the team believes will require the analyst's greatest attention this year. Be sure to ask about success measures, team responsibilities, major analytical priorities, systems, stakeholder relationships, development opportunities, and how the role supports Lumen's broader strategic and financial objectives. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.